Welcome to our ESG webinar, the impact of ESG on return on equity and effective climate reporting for finance. This webinar is being recorded, so please get in touch afterwards if you'd like a copy of the recording or the slides, and do please share with any colleagues who are unable to attend today. We're using the GoToWebinar system today, which allows you to ask questions on the right-hand side, and we'll do our best to answer any questions either towards the end of the webinar or after the webinar. We'll reach out. We're delighted to have both Legerity and Roland Berger here today and a packed agenda. So first we'll start with Roland Berger. They will look at an intro to ESG for financial services players, the impact of ESG on European banks' return on equity and operating model, and ESG risk rating of key insurers and a sustainability map for insurers. And then Legerity will look at the role of finance in climate reporting, the latest ESG accounting guidelines, the benefits of a net zero data and accounting framework, followed by a demo. So now allow me to hand over to Philippe Blazer from Roland Berger.
Yes, thank you very much, Mike, for the intro, and a very warm welcome also from the Roland Berger side. It's
Philippe, I think your audio's cut out a little bit.
Yes, I think we lost Philip. I can maybe continue on my side. So
okay, thank you.
Good afternoon, all of you. So my name is Frederick van Gijsegem. I'm partner at Roland Berger, based in Brussels, and I've been supporting at Roland Berger multiple leading banks and insurers in recent years. And I'm here today and happy to be here to share with you some insights of recent research that we did on the impact of ESG on the profitability of European banks. And I'm here together with my colleagues Philip and Laurent. Laurent, maybe?
Yep. Nice to be here. Thanks everyone. So I'm Laurent, I'm a partner in Roland Berger, based in Hong Kong, so it's a bit late, and greetings to colleagues or to clients or to attendees from Asia to be joining quite late tonight. And I will be speaking. I'm specialized in insurance, and I will be speaking about ESG for insurers in a couple of minutes. Let me try to get back to Philippe if we get it back.
Yes, thanks, Frederick and Laurent. Maybe on the next slide. Sorry, one more. So sustainability has increasingly become more important also for financial services players over the past months and years. It's now really turned into an imperative from what it has probably been a couple of years ago, a bit of a marketing gimmick. And this for mainly four reasons. One is simply to leverage opportunities. So clients demand it, and there are relevant business opportunities with tangible bottom line impact. Frederick will talk about that later. Two, plain and simple, the regulator demands it, and this will only increase. Three, it's also crucial from a risk mitigating perspective. Think about transition risk, think about stranded assets, and so on. And four, for some financial institutions, it's also pure convictions. So maybe many companies are now convinced that it's simply the right thing to do. Having said that, and now I'm on the next page, why does the industry not move ahead quicker? Next page, please. Yes, thanks. Well, we see mainly three key reasons. One is a lack of true management conviction, where other topics are just more pressing. Too often ESG is still be seen as a marketing topic. Again, we see that is about to change. More and more management boards, they realize that ESG is here to stay and is indeed crucial for the reasons I mentioned on the previous page. Then second, as with every new topic, changing the organization and enable them takes time. Old processes, old products, old mindsets. And then three, and probably the most important topic, is the lack of industry standards, and transparency makes it incredibly difficult to move the organization towards sustainability. There are currently plenty of initiatives and regulatory frameworks emerging, and to keep track with this takes a massive effort for all organizations. So if we can go to the next page, please. So what is the Roland Berger vision of the sustainable bank of the future? We are convinced that financial institutions must embrace ESG beyond pure products and services to monetize on the opportunities that clearly ESG brings. Therefore, we see action points on both business model, but also the operating model. So on the business model, a shared vision on as USP, supported by values, concrete targets, and strategic initiatives with a full top management endorsement and a holistic sustainability strategy. So addressing both direct and indirect ESG impact beyond risk and returns. Then a foresighted and data-driven steering of the bank, an integrated ecosystem offering, including strategic alliances and communities to address needs holistically, also beyond banking. Not all the required products and services can probably be delivered by the bank themselves. So you will need to work together with partners. And then finally, on the business model, a multi-channel offering putting individual client needs and values at the core to really engaging client needs, clients on their own journey. And then on the operating model, an adjusted credit scoring model and integrated supplier screening with an in-house approach and to identify sustainability and climate risk. A data strategy and powerful CRM to understand and target customers in a personalized way. Sustainable and innovative workspace and branch concept geared towards customer and employee needs. This has become obviously more and more important over the past months and 2 years. And to conclude, finally, adapted management models, processes, and infrastructure for increased agile and sustainable ways of working. So that is a bit our view on the sustainable bank of the future. Again, this goes far beyond sort of pure products and services, but we are convinced that it needs to be viewed as a holistic approach. And having said that, I would hand over the voice to Frederick, who will lead you through the impact of ESG on return on impact and return equity on the operating model. Frederick.
Great, thanks a lot, Philip. Thanks a lot. So in fact, when we look to this, topic, yeah, we clearly see, and Philip said it. It's obviously it has some marketing value, and it is clearly a kind of buzzwords in the discussions that we have. But we also get a question from many bank executives. Okay, we see many good reasons to go in this direction, but will it in the end not weigh on our profitability? What is the impact that I can expect there? And that was clearly the motivation for us to look a bit deeper into that and to look into the evolution of, on the one hand, the ESG score of individual banks, and on the other hand, their profitability. And this is what you will see now on the next slide, is a study that we did on more than 100 banks. And for these 100 banks, we looked into their ESG performance between 2002 and 2020. So that was a bit the time frame that we used. And we based ourselves on a scoring of 186 metrics across the E dimension, the S dimension, and the G dimension. And maybe to start with, on this slide, you see basically the overall ESG evolution for this full set of European banks over this time period. And the first thing that you obviously see, yeah, is that banks have been moving in recent years. So we see that the total ESG score went drastically up, so plus 79%. Maybe two things on that. First of all, we see that that has happened, yeah, in kind of waves. So we see a wave between 2006 and 2010. So then there was a major increase that was realized. And on the other hand, also in more recent years, so I would say as of 2016, also there we see that that important increases have been realized. So that's the first thing. So there were clearly two waves in recent years. Secondly, we also see that an important part of the increase stems from the E initiatives. So there we do see an increase that took place by 180% in terms of yeah, E score. So that's clearly the big contributor to this increase. But obviously that's that's one part of the story. So that's the effort that has been done by the banks, and it's very nice to see that that the sector has been moving. However, of course, the question that we wanted to respond to is, okay, what is the impact on profitability? And if we go to the next slide, there you basically see the results that come out of our analysis. For the more technical / econometric skilled people amongst us or in the audience, there is the footnote that explains the methodology that we use below. But the idea here was really to look, okay, when a bank takes an E initiative, an S initiative, a G initiative, what do we see happening in the years after in terms of return on equity? And obviously, we looked into the effect that we can attribute to this E, this S, or this G initiative in order to get reliable results. So what do we get out of this? In fact, we get a very interesting picture. We clearly see that the E initiatives that where a lot of effort has been made, that there is a positive impact on profitability. And to be more precise, it's an increase of the return on equity by 0.3 percentage points for each sizable E initiative that is still taken. So obviously, I mean, it is statistically significant, but it's also 0.3 percentage point in the environment in which we are right now with relatively low profitability of banks. This is a sizable, an economically sizable increase. And on top, we do see that some banks multiply the efforts on the E dimension, and as such, also multiply the impact on their profitability. So there we clearly find evidence of an increasing profitability, and the drivers behind are typically the new business opportunities that this generates, also the higher efficiency. I mean, also on the cost side, of course, there is an impact of E initiatives, and also the better risk management, where some of the banks that took initiatives here can come up with. So there, clearly a positive impact. If I go to the bottom, to the G initiatives, so there we also find a positive impact, very interesting to see as well. It's slightly lower, but it remains significant. And here a lot has to do with the independence of the board, with the remuneration, also the alignment of interest between the bank management and the stakeholders, and also with the transparency and ownership structure and oversight that obviously also comes with benefits on the cost side. And in terms of perception in the market. Interestingly, when we look to the S initiatives, we find a negative impact. We find a negative impact on profitability. And the underlying initiatives that we find back most, basically, when we look into the S initiatives that have been taken, are, for example, working on the working conditions and the employee welfare, working on equal opportunities, working on engagement with local communities. So we do find that, in fact, when we look purely to profitability in the short term, we see that there is a negative impact on profitability, which is also, by the way, significant. So that's, of course, an interesting one. How do we look now to these results? In fact, if you think about it, it's not, I mean, the fact that E and G comes with a positive profitability impact is, of course, a big plus and should be a motivation, further motivation for banks to move in this direction. What we see on the S side, the different picture that we see there, basically only tells one part of the story, because this is, of course, the near-term impact that we observe. However, in the context in which we are right now, the labor market context in which we are, where we see there is the talent shortage across the board, also in the financial sector, we do believe that despite the near-term impact on profitability, that in the mid to long term, it remains important to invest in this S dimension in order to remain relevant as an employer moving forward. So in fact, you could see this as a bit more a mid to long-term investment that these S initiatives represent. So now, of course, this gives you a view on what you can expect in terms of profitability impact. The next question to ask then is, of course, okay, what are now the concrete initiatives that I can take as a bank in order to move in this direction? And that is also something that we analyzed, that we looked into. And if we go to the next slide. What we do see, the underlying initiatives that are taken are definitely not only initiatives that only concern the outside of the bank or the very visible part of the bank, but we do see that there is room to take initiatives across the board. What you see here is the full set of business and support functions within a typical bank, and we do see interesting and impactful initiatives or potential initiatives for each of these departments. So I will not go through every point here, but this clearly gives a view on what the menu is, where as a bank executive you're confronted with, and where you can structure your ESG efforts alone. Maybe to take a few examples here. So I think when we look to the board and executive level, we all see that the governance mechanisms are being steered towards more transparency, towards more monitoring mechanisms, and also towards a clear green objective that is given to the key decision makers here. So that's something that we clearly see moving. But what we also see is that some banks are setting up specialized committees and groups that go even further, that dive deeper into the concrete ESG opportunities for the institution that they're steering. If you look to retail banking, there are of course the obvious ones link mortgage pricing, for example, with sustainability targets. So that's one many people know. But we also see that in the S sphere, some banks are focusing on access to finance for the underprivileged. So there we also see interesting initiatives that are taking place. If we look to corporate and investment banking, so again, there are the typical initiatives around credit scoring and credit exposure targets that many of you know. But we also see, and Philip already referred a bit to that, we see players that also go beyond the traditional banking services and that provide ESG advisory, because of course financial institutions are very well equipped, dispose of a lot of data that they can lever to understand better how, for example, the climate footprint can be optimized of a given company, how compliance with standards can be assured. So that's definitely also an interesting one that we see. And maybe to take another one here on the private banking front, what we also see is that many players on the investment side are integrating ESG criteria in their core investment process. If we now look, for example, here in Europe, to many leading banks, they basically they integrate in the 360 degrees interviews that they have with their customers, clearly questions on, okay, how important is the environment for you? How important is water pollution for you, and things like that, in order to target the investment advice that they give much more towards these ESG preferences of the customers. And today it is still optional, but as many of you know, in the context of MiFID II, there is a movement also to come up with regulation there and to come up with a compulsory questionnaire and set of questions that needs to be integrated, just like it's done for risk taking, for example, as we speak. So that's more on the business side. A few examples, maybe to take two examples on the support side. One that we see on HR basically is that in some financial institutions, employees are incentivized to live and work in line with the defined ESG targets. So a tracking is being done of, for example, the way they commute, the way they consume energy at home, the social engagement activities that they do, and that is taken into account when their annual bonus is being determined. So that's also, yeah, an interesting one, and also, of course, is helpful to create this sort of ESG dynamic within your organization. And maybe to take another one, is that we see that many banks are also looking into their communication efforts and favor channels that have low environmental impact, and also communicate proactively about the choices they make in their communication means, to link that with the social purpose that they see for themselves. So as you understand, a lot of things that you can do, a very extensive menu that you can choose from. And on each of those, we do see interesting evolutions, interesting practices arising. If we now maybe go one slide further, what is important, of course, when you start implementing this, is to also measure to what extent you reach a tangible impact. And that's also a domain where we see interesting practices arising, and where we see a lot of good ideas on how to typically measure and track the progress that is being made. And obviously that goes with looking into client engagement, employee engagement, also the skill set that the employees build. But we see more and more that banks, financial institutions, also looking into the profitability of the ESG initiatives that they're taking, and that connects well, of course, with what I explained before on the impact that you can expect on profitability. So we do see that the business case behind that, this one is becoming more and more important, and linked to that, of course, people also want to understand better and better what the impact is on their revenues, whether this is in line with the market, yes, no, and what they, in order to take meaningful action on how to steer their ESG initiatives towards a maximum business impact as well. So positive impact on profitability, a big menu to choose from, KPIs to track. How, as a bank executive, do you now start working with this? And that's maybe something that where we can give you a few ideas on the final slide for this section. It's a very new field. There are a lot of things that you can do, and a lot of use cases are being developed as we speak. And obviously that makes that the field is not that easy to navigate in, and therefore when a bank wants to optimize the positive impact it has on society, but also on its own profitability, we typically recommend to tackle this question in 5 steps. It all starts with defining a high-level ambition. So where do you want to focus on as a bank or as an insurance company? What are exactly the gaps that you want to fill, and how far do you want to go in that? And that's a very important first discussion that you need to have, and that is obviously structuring for all the efforts behind. So creating here a clear framework where you can work with is absolutely key. Secondly, once you define your level of ambition, you should look into the status quo. So what are your strengths, your weaknesses, and how can we look into the strategic positioning that we have right now? based on the status quo, you can then look into the most inspiring best practices, good ideas from everywhere in the world, basically bring in experts, bring in people that actually work with these initiatives in order to learn from them. And once you have that, the important exercise that you need to do, of course, is to prioritize the actions. And you see there on the left-hand side an illustration of a framework that we're using to prioritize the ESG actions that you take. And then obviously execution remains key. A good action plan at the end of the day that builds on the experience from other organizations, from your peers, is absolutely key to make this a success. So I would like to end here. And with that, with this analysis that we did, hand over to Laurent for a view on the insurance industry.
Yes, thank you, Frederic. And that's a nice page because yes, it's a burning field, but at the same time, like defining the burning platform for insurers to transform themselves, like with respect to ESG. And maybe we can move to the next page. Which is showing. I mean, this one is actually public figures, but gathered here, and the fact is that even though insurers have also been quite engaged, advanced, and doing quite a lot of efforts, and even more so communicating a lot about what they do, we do see that there is some strong gaps between players. And so these figures are actually ESG risk rating coming from Morningstar. So that's again like public information for investors willing to look at these companies, and it shows that quite a high number of insurers are actually quite financially exposed to the unmanaged ESG related issue, and not only. I mean, we could have assumed that this would be like a developed versus less developed markets. So yes, at least on the left-hand side, the low ones, you can see this is mostly developed players on developed markets, or quite the leading insurers. But even on the right side, I mean, the one having high risk are also like players coming from very mature markets with very mature things. So there is still a gap in doing this, and this financial exposure is quite significant for players which are listed. Definitely on their share price. Having said that, maybe moving to the next page. Yes, thank you. What can insurer do? And again, using the ESG framework, they can do many things, and they can do things along the E, the S, and the G. So probably to make it sharp at this stage, because I'm going to deep dive on some of them. So yes, indeed, insurers can decarbonize their own business activity. If we look at the E side, so that's definitely one thing. Following the SBTI or net zero, having probably like most of them, if not all of them, have already this thing, reduction of scope 1, scope 2, scope 3. So that's already quite engaged. Then there is things which are sustainable core insurance offerings, and I will deep dive into that one in one page. Which is definitely working on their product design, on the underwriting, on the claims. So definitely the core activity that makes an insurer an insurer. And I will come back on this one. Again, on the insurance side, sustainable investments. This is definitely a big part of what insurers are doing, and they have quite strong influence on the markets by their action and the way they invest. So this is definitely something that has been top of the agenda for quite some time, and I will come back on this one in a few pages. And obviously on the S and the G, so not to under-mention it, but that's things that insurers have been doing, working on social responsibility. Also quite some efforts and activities here on charitable activities. This has been seen, for example, during the COVID. Plenty of players have been playing the health insurance part of their portfolio or their activity to be on the front line from conviction, but also from marketing perspectives. But that's one thing. On diversity and equality, same as every company, they are working on these things to promote diversity in different leadership positions. But I'm not insisting too much because it's pretty consistent across the sectors. And on governance, obviously also working a lot on transparency, and that's probably where Legerity presentation in few minutes will shed some light, because it's about reporting. So that's I'm not deepening too much on this one. So now I'm going to deep dive in two areas. So one, the one I mentioned about sustainable core insurance offerings, and two, the one about sustainable investments. So if we go to the next page, thank you. On sustainable core investments, so probably three things. Again, it's a very broad topic, and when we speak about insurers, the area is very large with life, non-life, the personal lines, commercial lines, P&C, health. So there's a number of areas. So try to summarize this with a few examples to make it concrete. On sustainable products and solutions, on this one, obviously this is about promoting low emission and energy efficient technology for both B2C or B2B customers. And the examples that we see on the markets are taking multiple ways. So technically on the personal lines, put a few here, but this is things about like a green property rebuilding, property renewable energy reimbursements, which are also like depending on the policy activated in the various markets. Promoting a low mileage or low emission vehicles, so typically the insurance on NEV, which are also quite complicated because the residual values of a battery are quite a mess for insurers and for actuarials to calculate. Discounts and sustainable behaviors, which is also quite interesting. So it's not something new completely in the insurance, because this activity of pay as you drive, pay as you consume, pay as you do, are things that have been existing, but in the context of ESG and sustainability, it's definitely something which makes sense, because if you drive less, if you drive better, you can also get discounts, not only for the distance or the risk, but also for your contribution to reducing emission. On commercial lines, again, a number of examples. So you can see here insurance, obviously, for renewable energy and emission reduction. So that's definitely some type of B2B corporate solutions insurance. Energy savings and grid building insurance, so also like to promote and to encourage their clients to do that. Topics around insurance on renewable energy production, which can take the shape of a yield insurance, for example, for wind or solar or these kind of activities, but which also would be declined on the life side, for example, on the storage of renewable energy, which is obviously a very tricky question because you cannot store it, but still next to a wind farm or solar farm, you would have some hydrogen temporary storage, which also can create some high risk, which obviously need to be insured. And so this is creating new opportunities also on top of new risk, and so new opportunities for insurers to insure. Moving on the sustainable client portfolio, which is a good transition. So here we are speaking more about underwriting, but not only. So definitely insurers have been defining guidelines and targets on this thing, and they align their underwriting on ESG criteria, aligning it not only from an outside-in perspective, but aligning also the KPIs of their internal underwriters, which will have some influence on their bonus at the end of the year or this thing. So which is quite interesting, including, for example, alignment on temperature-related metrics, which as a cascade or as a consequence is having positive influence on their clients and on the thing. The second point, or probably the next 2 points, are about more collaborating with clients in defining sustainability strategies, or actually providing risk management services. And this is definitely an area where insurers are keen on pushing, because it gives them an additional touch point or contact with their clients in adding value in providing these risk management services. And definitely sustainability topic is an area where they can provide, because they own the data, they are master at data, and that's definitely a place where they have a full role to play. And the last point on sustainable portfolio is about like typically increasing customer share or decreasing customer share of sustainable companies or non-sustainable companies, depending on the way you take it. at the expense of GHG emission. And this is typically discontinuation of insurance for construction of coal mines or different things, thermal power plant, new risk with dual sense. And maybe to give an example of what it means on the real life for an insurer, I cannot say the name, but got a client, they announced banning completely any insurance from coal-related companies. But as a starting point, they add in their portfolio some coal-related lines. So it means for the renewal and for the thing, it represents for them a big hit in terms of premium and development. But they took the decision, so they keep it and they publicly announced. But this is also inducing the fact that for any renewal or subscription, they are requesting explicitly to their clients or to the people which are asking to be insured to provide a full detailed roadmap about their decarbonization plan. Because you could be in a situation today but having a clear roadmap. And this is inducing behaviors on their client side, which are triggered by the fact that if they want to be insured, they need to provide this. So quite interesting development. Maybe last thing that we don't mention too much when we think about insurance and sustainability is about claim management. So this is also an area where insurers have quite an influence. And here we can see just a few examples that I've been putting here, but typically promoting and encouraging recycling or use of recycling materials or promoting less consumption. So that's definitely one thing. And you can see some examples here on property repairs, motor, electronics, typically working with loss adjusters to ensure that the property is restored with recycled materials. That's also having quite an influence as construction is a highly polluting industry in general. Motor repair, which is collaborating with salvage recycling firm to collect undamaged parts and replace them. To the extent that you have some insurers, again I can say the name, but which have been developing an activity, an in-house activity to actually dismantle cars and use these spare parts for repair. So quite interesting to go to that extent. And this has obviously a sustainable impact, but very pragmatically has a direct impact on the loss ratio of insurers, which is also like a very financial important element of their profitability. Maybe moving to the next page, and for the sake of time, I'm going to be probably faster. So this one is about sustainable investments. So probably an area that has been well discussed and disclosed. So again, here we are speaking about different type of investments that could be either financial investment, but also physical investments. So some insurers are jointly investing in a physical project with their clients or partners. It's interesting. This is triggering some behaviors again and reinforcing their collaboration or their partnership with some of them. And here we can see the array of investments. So on the left-hand side, it's more exclusion of assets based on the norms, exclusion based on criteria, exclusion or inclusion based on the ESG evaluation impact aspects. So that's the thing. And more on the right-hand side, you can see it's more like opportunity exploitation. So actually targeting investments either from a pure sustainable perspective or from a financial and sustainable activity. So I'm not extending too much on the investment part because I guess it's been discussed extensively elsewhere, but still relevant to speak about it for insurance. I'm probably stopping here, moving to the next page just to conclude on our part. Yes, so just auto approach challenge. So Frederic mentioned a bit, but probably the array of services that we typically provide is to support clients on building the foundations, which is about like getting the thing straight, understand where the basics, having a fair understanding of what is going on in terms of regulatory benchmark measure. I guess it's most insurers are already quite advanced in that stage, but still it's something that we are requested. Second, it's about developing a full-fledged sustainable strategy, whatever it means and whatever we put into it, but that's definitely something that is quite comprehensive exercise and need to be defined properly. Third point is to work on the specific lighthouse projects, also quite relevant. So I mentioned about investment, but targeting or defining which investments could be very large projects and also important. And last point, sometimes working on sustainable governance within the company, but also including at board level. So we've been requested sometimes on this. And I stop here to hand over to our dear colleagues of Legerity for pursuing the show. Thank you.
Great, thanks. Yeah, so that's a very interesting presentation. So I'm Mark Miller. I'm from Legerity. We're an insight software company. I'm the IFRS Global Lead at Legerity, so I'm an accountant. And I'm joined by another accountant and also MBA, Atanas Jelev, who's a client advisory director, who also specializes in finance systems, and he's going to be doing our demonstration today. So what we wanted to talk about is a little bit more on the reporting and measurement around ESG. So as the other presenters have talked about, there's a lot of aspects to ESG and a lot to think about, but we want to drill into the reporting and measurement. And around that, as this becomes more of a sort of standard important aspect of external reporting, we think the finance has a key role in this, probably in part due to their position in the organization, trusted advisor to the CEO and the execco, but also, the approach that they take, trusted and accurate and data and evidence based. Finance teams are usually used to managing changes in terms of getting new data and connecting new systems together and creating new reporting. Whenever you're doing external reporting, you need to underpin that with MI and performance management, again, in the area of finance. And a lot of the metrics are actually financials. So these will be financials cut in different ways, affecting your capital, liquidity, your P&L, and measuring the financial impacts of climate risk and trying to quantify that. And of course, making actual change means these things need to be aligned to personal and company objectives, and finance play a key role in those processes. And finance would often own the decision-making frameworks, the business partnering frameworks, and these kind of ESG metrics need to be embedded in that. So a lot of what we're talking about is thinking of these sort of ESG requirements and how finance can play a big role in the kind of support that they need. So one thing that is apparent over the years, ESG is not a new topic. There are many frameworks out there. It's a very complex area. There's a bit of a lack of standardization, but the good news is there is a push now to create more standardized frameworks. So certainly in the UK, TCFDs became a legal requirement for UK companies, and the new ISSB, the International Sustainability Standards Board, has actually consolidated a lot of the work from, say, TCFD, SASB, CDSB, these organizations, and has actually issued some new frameworks. If we go to the next slide, some new exposure drafts that were built around the work of the TCFD. So I think there is a bit more of a standardized measurement and reporting framework around ESG. And in particular, when we talk about ESG here, we're primarily talking about the climate aspects as probably the biggest area. And as you can see here, we're talking about emissions and then cuts of financials to think about capital investment, opportunities, risks, transition impacts, and how you incorporate those into decision making. So one other important area, because we're primarily focused on financial services, I think, on this webinar, and certainly as our organization, we're looking at supporting financial institutions primarily, and the Partnership for Carbon Accounting Financials has actually come up with some good methodologies for banks, as you see here, around different kind of asset classes. And actually how to quantify the emissions. So these sort of standard formulas are very useful, and I know that these organizations are also now looking at insurance and underwritten emissions. So there's some frameworks are being put together, approaches being put together. So that's a good news for all of us who are involved in this activity. So if we think about it from a user perspective, you know, when you're confronted with all of this data and trying to condense it down into sort of reported metrics and embed those in the organization, you've got all the sort of standard problems that you know, you would find in any normal finance process. So audit trail transparency, data lineage, validation, you know, processes to manage data like allocations, amortizations, you know, adjustments for errors and things like that, but then also flexibility to adapt to changes, and that is certainly the case. It's a very dynamic environment, and all of this data needs to be very granular, but also with hierarchies and multiple dimensions and all the reconciliations to bring together different parts. So there's quite a few challenges to think about when we're thinking about this data, and that's where we believe our FastPost platform can really help. So what you see here in the top left is just a bit of a picture of the core elements of our application. So we subscribe to data, so, you know, CO2 rates, you know, your financials like expenses. We can ingest that kind of data, we can transform it, we can perform calculations, and we can convert that, importantly, into validated journals and metrics in an auditable and controlled data layer, with a wraparound of sort of workflow and orchestration to help manage the process. And that can then be used to feed your statutory reporting, your MI reporting, and your other databases as required. And what's important in our view is that these data structures enable you to handle wide ranges of dimensions. And when we think about ESG, you know, there's going to be an awful lot of different cuts of data that you need to manage to cover different initiatives, different parts of the organization, and different aspects of the whole frameworks that we're dealing with. So having a high performance system that can manage those dynamics and those dimensions in a flexible way, we see as very important. And there's going to be more than one use case across ESG, so you need to be able to record multiple use cases, and of course adapt to these standards as they evolve. And you know, what we're certainly looking to do is not put in place, or you know, to help companies put in place sort of point ESG solutions, but we're obviously also talking to companies about wider transformation and goals and the overall finance architecture. And of course ESG, we believe, should be absolutely part of that architecture and integrated into it. So if we just go to the next slide. So, you know, apart from the sort of functional capabilities of the system, you need to make sure you can integrate. You know, we're moving into a digital world, streaming world, so integration into those kind of technologies is key, and the orchestration of the process. So there's going to be multiple steps, multiple users, multiple data formats. So orchestration around the whole data flow is very important. You know, just like you would for any key process, monitoring and scanning of the information, making it accessible for reporting in a variety of different ways. So our application has reporting tools embedded, but importantly, we can interact with all of your BI tools, any of the BI tools in the market, but also wider data warehouses. So in the architecture, you don't have to have your ESG measurement and calculation platform delivering you all the dashboards. They can be part of a wider BI environment where that data is stored and integrated and controlled. Obviously, security, a big issue. A lot of this data is highly confidential, particularly when we're talking about, say, for example, remuneration of executives and things like that. And then deployment, you want some deployment options. So being relatively technology agnostic and cloud enabled is very important. So if we go to the next slide. So this is all about data. So we're talking about, you know, controlling flows of data, and importantly, we need to give people visibility of that data. So there's a lot of reference data, factors, emissions factors, things like that. So screens to give users access to that, transactional data that people can enter but also view in a simplistic way. Along the way, there's going to be, you know, calculation results. So you need to be able to follow the journey, understand the calculations, and view the results. There will be changes as we go along. So the way things are measured at one point in time could be different. So you need a system that can help you manage changes to data, but also all the configuration, all the rules that you've put in place. You need a sort of audit trail for that. These could be quite long processes, so statuses, so people can understand how the processes is running and where you are in the process. And then I think really important is just the volume of information. So if I look at external reports, obviously there isn't too many ESG metrics necessarily, but if you start thinking about how you embed that in the organization and actually manage change, you want those metrics cut across an awful lot of dimensions, and that's where you need the kind of tool to handle those granular volumes and those granular cuts of data. And of course, with a cloud-based solution, that means that kind of performance can be accessible on demand and scalable with your organization and as this topic grows. So just the last point I just want to mention is there are a lot of rules within ESG reporting, particularly around the calculation, say, of emissions across the different scope areas. And within FastPost, we have what we call legal and no-code expression language. And what's important about this is that users can manage these kinds of rules themselves. So you don't really want this to all be about coding, sitting in IT or with our offshore developers. So within the solution for your ESG measurement and reporting, important to have user-managed rules that are also easily understandable. And we think legal is a great option for that. And on that note, I'm going to hand over to my colleague Atanas, who's going to give us a demonstration of the software, and I think he'll show us a legal rule.
Excellent, thank you, Mark. Thank you for that. And without further ado, let me just switch over to our solution here, and I'm just going to quickly log in and show you exactly what Mark was talking about, which is the legal expression language that we use to develop accounting rules. So within the accounting menu of FastPost, we've set up a number of accounting rules. The accounting rules logic is visible and accessible to users with administrative rights, meaning that people can only go in, edit, and specify rules that have the right security protocols. So let's look over to one of these rules. For example, the interest received due. So if I want to go and look at the specific rule, we can see that's a fairly straightforward, as Mark said, no code, low code sort of entry. Specifying something like this in Excel would be quite relevant, and we can do it straight away within our solution. So if I go into the edit screen, that immediately brings up a number of menu options that I can affect, and effectively I can take that rule and apply it to a different GAP or to a different ledger that's managed within our solution. And more importantly, as we say, taking control and ownership of those rules now becomes part of the finance function rather than the IT function, where one can go in and view, edit, and obviously report on those rules straight away to auditors and through to make sure that those are aligned to the accounting policy, the group accounting policy. So that's a really intricate way and really sort of an easy to use way for finance to go in there and make sure that what we are applying from an accounting rules logic is applicable and user friendly as well. So from that, I'm just going to switch over to look at what an ESG sort of accounting solution could start to look like. As we mentioned across this webinar, we've spoken about what banks and what financial institutions can do. So one of the aspects is, from an accounting, all the accounting adage, is like what is not measured cannot be managed. So what we try and do is really bring the rigor of the finance data through to ESG metrics. And I'm just going to show you a typical view of a trial balance. So let me just log in again, and I'm going to show you that view of the trial balance of a typical financial statement. So I'm going to look at my 2022 year across, let's say, all 4 quarters. Now I've come to the menu here, which shows us the typical balance inquiry or the trial balance view. On the right-hand side, you can see a whole host of menus, which are the segment values that Mark referred to earlier, which gives you that level of segmentation across all the ESG data elements that one would need for down the line reporting, disclosure reporting, and disclosure management. On the left-hand side, you'll see the way that we've set up our solution is that it's applicable across multiple ledgers, multiple entities. We can bring in multiple different types of accounting treatment, so across the different IFRS, US GAAP, UK GAAP, especially around now ESG as it's forming the standards through TCFD, ISSB, is where this all becomes quite relevant in terms of the applicability and usability of those ESG treatments. What I'm going to look at is all the transaction currencies within this view. So if I just hit on the search button here, and I'll focus on the results, you'll see here typically the first 4 lines are applicable to sort of any sort of trial balance view with opening balances, closing balances in the year, and you'll see the currency is in GBP. So we have some accounts like payable, travel costs, energy costs, etc. But what's interesting is that the last 4 rows at the bottom are, you'll see here this is applicable to the CO2 impact, to the CO2 kilograms. That are the relevant transactions that have occurred off the back of all our activities. So we're going to look at one specifically today, which is the energy CO2 generated, which is this line here. So if I want to filter on that, I'm just going to select the specific account, which is effectively a view of my carbon ledger. So I'm just going to go and filter on that, and I'm just going to paste it, and I am going to just hit the search button. And this focuses the view on the specific entry on this energy CO2 generated. Now, using the menu options on the right-hand side, the segment values, if I want to look at, for example, which how that aligns to the buildings across the group or across this entity, I'll just flick this on, and you'll see that we've got six buildings, beginning with Austin, Texas data center, and finishing with the Manchester data center. All across that, you can see the CO2 impact across the quarters in a very similar view that's used by the finance system users today. Let me go and drill through now in terms of what that first entry is, the 545710. So where does this originate from? What does it mean? So using FastPost, we've got the full line of sight of all the way through to transaction. And once you start to drill through, you'll go from the trial balance, which is where we were just now, through to our journals inquiry screen. This will show us effectively what that journal posting is. You can see the transaction amount that we just looked at, the 545, and any further details below that in terms of the total debits and total credits. So it really is applying that finance view in terms of the management of making sure what's coming in, debited versus what's coming out credited, and vice versa, of course, in terms of the way that we view our data in this. So what's typically good about this is the richness of data, the richness behind the detail in this journal. So making sure that we can trace it all the way through. We can see here this is an energy CO2 generated account. And if I want to, for example, view my energy type, let me just flick this on top here, and you will see that if I hit the search button, this is a non-renewable energy type, which is applied to the specific journal entry. Now, further to this, I want to go and view the event that created that specific entry. So again, going back to source, transaction, and to the core of where this all began, we can see that on the 28th of Feb, we had an amount coming in, so of 17,951, which is effectively your financial amount, your financial transaction. And using the metrics, using the fields that Mark referred to earlier, like your kilowatt rate, your GBP kilowatt rate, the CO2 rate applicable to the specific type of energy, and energy factor, which are all external data sources coming through into FastPost Net Zero, we can calculate the CO2 impact, which is the 54571 that we saw previously in the trial balance. So in a way, this is what the final entry is with the event that created that, and in a way that's a quick sort of run through of how data can be visualized, how it can be calculated using a finance system solution like FastPost, which has the full line of sight, the open rules through a low-code, no-code legal expression language entry screen as well. So thank you very much. I'll hand over to Mike to conclude. So I just want to flick back over to here. So thank you very much. Over to you, Mike.
Fantastic, thank you, Atanas. And if you'd like a more in-depth demo with Atanas or Mark or both, please just reach out to info@legerityfinancials.com. We also have a report we published recently on accounting for sustainability, so that's finance net zero, having a look at the role of finance within ESG, and for that you can go to legerityfinancials.com/ESG. I think if we go to the next slide, Roland Berger themselves have a number of resources as well on their website regarding ESG. So do please go there and have a look if you're interested in any sort of further information there. And I think if we go to the next slide, yeah, all of our contact details there, like I mentioned, info@legerityfinancials.com or legerityfinancials.com/ESG. And I think on the next slide, it just remains for me to say on behalf of everyone here, thank you to Roland Berger for joining us today and the Legerity team. And thank you to everyone for attending. Thank you very much.
Thank you very much, everyone.
Thank you.